All right, hey everybody, how you doing? All right, the most compelling one of our initial run-throughs is Southwest. Why do I say that? Well, we have the market that's down right now. The market's down a little bit over 0.5%. Yet this is up just a little bit. It's not rallying crazy, but I like this. I like the speed at which it's gone up. We had just this little dip here, and now we got another leg up. We've taken out these highs. We have the neural index in the green here. We have the predictive high and lows above yesterday's high or Friday's high and low, and then we have all three predictive predictive differences. All of them north of zero, and all of them excuse me, all of them positively sloped with the short term, the most positively sloped. So now we turn to, is there something we can do here with the options? Okay, first let's figure out what, if anything, we can do there. Okay, so 6110 is our last, print. We have regular, I just want to check the, it's a little bit, a lot of this stuff with March rolling off on Friday, these are definitely, the open interest isn't crazy, but that's because March just rolled off. I'm not worried about this. March 29th. Yeah, these are still only 15 cents wide. This is a nickel wide. We can definitely trade this. So let's go out to let's give ourselves 2 weeks. So March 29th, and then the implied vol for the 29th is 22.4. So to the upside, we are targeting right around the 63 line here. Okay, full standard deviation is about 63.40, 63.10, 63 seems perfectly viable to me. 63.10. So 63. So let's look at a 62-63 call spread. That's the. That thing's trading 30 cents. Okay, so 30 cents. Let's go through the exercise here. We're figuring out what the. If we get this thing for 30, this is the 62-63 call spread. That's going to max itself out at 63. We're going to pay 30 cents to get into this guy. So we can make 70 cents. We can make 70 cents net, which is a dollar wide spread, less the 30 cents we would have to pay to get in. 70 cents, that's 2.33 to 1, right on the lower end of what I would want, but still, I think that in a market like this, I think that this is perfectly viable. You guys understand? Or any questions on my rationale here? Actually, we can probably try and work 25. We can probably work a quarter bid here. Okay, I think I'm going to put that out here. I did record this, so okay, folks, I got the recorder going. So what I have up here is Facebook now, and obviously something is fundamentally different than Friday, with Facebook down about 5.5%. Before that, everything was actually it was almost a well, not almost, it was a bullish indication in taking out these highs. What happened over the weekend is I don't know if it was early this morning or over the weekend, was this report of a data breach, but Mike Patton made a really good observation, one that I forgot about, was that this was known 2 years ago. There's the link, or a link, that essentially 2 years ago there was a data firm, and who was associated with Ted Cruz, or Ted Cruz was associated with them, that they were mining data from unwitting tens of millions of people. And so what I'm seeing here is I'm not necessarily of the ilk that I want to just buy it, but what I am willing to do is to maybe sell a put spread as opposed to buying a call spread, because we got vol's up 35%. All right, and if we can get something, here with this inflated premium and playing off of this volume coming in that's also with the 200 and not have to lay too bad of odds, I think that is a really good reward to risk. Well, we'll see once we take a look at what we're looking at. So in order to get any sort of premium, we're probably going to have to put ourselves out there for more than a week. But let's see what Friday holds. So the level that we're looking at here is essentially 172 to 172 half, and we do have a 72 half spread in here. So if we do a 70, excuse me, if we look at a 72 half put spread, and let's put it in normally just because it'll look better for. So the market on that is about, let's just say it's somewhere around 75 cents. So 75 cents. Let me get this out of the way. Let's look at the reward to risk that we have to lay here. We're laying odds in this one. Strikes again are 70, 72 half, 170, 170, 172 half, and we're going to sell this and buy this, and this is going to max itself out at 170 or lower. And if we take in 75 cents, we're laying 2.33 to 1, which is not horrible. Laying 2.33 to 1 to only be out there till Friday. So we can lose $2.50 less the premium that we collect, which is we could lose $1.75 on this, but we can collect 75. So our reward to risk ratio is we are laying 2.33 to 1. All right, Bob, I don't know what's going on with IB. I really don't, and I know that there's issues with that. I showed it that the strikes are open. They've traded. That's an issue for IB. We're seeing it here. It's actually traded today. I think before we went in, there was 17 traded on this line. Now there's 44. So somewhere around 30 of these spreads have traded. So I would give IB a call. They're the ones not listing. The spreads are listed, or the strikes are listed. But getting back here, laying 2.33 to 1 to play off of this area here, I mean, that is major support. You got volume, and you got the 200-day moving average. Looking at this over the last, when was the last time that Facebook was at or below its 200-day moving average? Oh, I'm nowhere, So I'm willing to lay those odds. It's not horrible. I mean, I would like it if we could get a little bit more than that. That looks like, watch Southwest here, folks. We're right here at where I said it wasn't going to be. This is unchanged on the day. If we get in right here, we'll get it. So it's trading right at it where it's not valid. We'll see here. No worries, Bob. Michael, check out the May risk reversal. I think that's what you're calling a risk reversal. Nice premium time to recover. But yeah, remember this is a short-term option play. I'm sure if I'll check with Scott. I would be surprised if he hasn't looked at Facebook already, but he may not have. I'll check with him though. So watch this thing. We're right there. Now it's above.
What we're theoretically doing is we have 500,000.
Okay, so the record, I did record this. I'm gonna. It's right there out of range. I put 60.90 and above, and it's trading 60.90 right now. So if it gets below here, I mean, I'm hoping that we get filled right here. It looks like it wants to trade. All right, so give me a second here on Facebook, and we'll see what happens there. Okay, folks. So let's talk about this again. What a stop order is, and what the different types are, and how we calculate different different risks and how we figured this all out. Okay, so we have two different types of stop orders. There's a stop limit order and there's a stop order. So a stop order, and they're both triggered by a trigger price. So let's just say, let's figure out how on a credit spread like we have on in Facebook, we figure out how do we figure out what our risk is, and then from the risk, then we figure out what our stop price should be. Okay, and probably the easiest way, or one of the ways to do this is to use the tracker. Okay, so we know that we sold this spread, and it's a $2.50 wide spread, and we sold it for 75 cents. So that means that we have capital at risk is going to be the width of our spread, which is $2.50, less the premium that we collected, times however many that we did, times 100. So in this case, we did let me get the calculator here. We did a $2.50 wide spread. We sold it for 75 cents. So we have $1.75 at risk. So we're willing to risk 50% of that risk. So multiplying that by a half, or by 0.5, that means 87.5 is what we're willing to risk. We know that we have 75 cents that we've sold it for, and so we add the 75 cents to it. And so if we get out at 162.5, that's risking half of our premium. We can do this on the calculator by just saying, okay, first to calculate how many of these you can do, you just figure out your risk, which is $2.50 less 75 cents, which I put in here. And so we know that we're risking $1.75. The premium that our allocation for each one is $750 of risk, so we can do 4.29. We know that we can't do 0.29 of a spread, so we either have to do 4 or 5. Rounding rules gives us 4. So we know that in this case, selling it at 75, we know that our risk is $2.50 less 75 cents times the 4 times 100, which gives you $700 of risk. So risking half of that would be $3.50, which is 162.5, which is the $2.50 minus 75 equals $1.75. Half of that, this is what we just did. Oops. We got $1.75 times a half, so we know that, and then we add that to our premium, and that's what. And so we know getting out at 162.5. Route is 163. So we know if that happens, if we pay 162.5, then we're going to lose $350, which is half of the capital at risk. Okay, so our trigger price we've calculated as, let's just call it 160. So if 160 prints in the spread, and I realize that this Facebook keeps going down. It's no fun watching this. But if 160 prints, we have a stop order out there. You can do two types. You can calculate it on if it trades $1.50. If $1.50 prints, then it becomes a market order. Hopefully, it's still offered at 150. That is a stop. That is a stop sale on this point, or stop buy in the case of a put spread. Or you could do a stop limit, which means that if $1.50 or $1.60 prints, then I want a limit order to come in with a $1.60 bid. Now the thing is with a stop order, you are guaranteed. Well, you're going to get filled. You don't necessarily know what price. And something like Facebook, it's very liquid. You're going to get filled within a dime of where you think. If you put a stop limit order in, you know what price that your stop is going to get filled, but you don't know if you're going to get filled. You only get filled at your limit if it's offered there. Okay, so that's the difference between a stop order and a stop limit order. If we continue to trade down here, I'm going to put out a stop order. And, frankly, obviously, I didn't think that we were going to keep trading down, but we are. Go figure. Facebook down over 7%. That's the biggest move I've seen in Facebook in a long time. But we'll see. We'll see if we're going to continue to trade down. All right, so that is a quick explanation of what stop orders are. I'll get this recording out to you guys, and hopefully we don't get stopped out. But if we do, we manage our risk, and that's it.